Hello, this is Brian Shannon from AlphaTrends.net. It's Sunday, the 3rd of February, 2008, and I took the day off to go skiing on Friday, so I'm getting the video out late here. But let's take a look at the action from last week. The S&P 500 finished the week with a gain of about 4.9% after the Federal Reserve cut interest rates once again, and that cut the loss for the year in half now. Now the market's only down about a little less than 5%. Year to date. So we had a great week, 4.9%. Obviously, that's a huge uptrend for 1 week, but don't lose sight of the fact that we are still on a primary downtrend. We've got this declining 50-day moving average below a declining 200-day moving average. When we look at the shorter term time frames, we see that we do have that pattern that we've been looking for of higher highs and higher lows in here. So to fight this trend just doesn't make any sense at all. And once again, keep an eye on this 5-day moving average. Well, the direction of the 5-day moving average was lower back in here. Once it began to flatten out, and then was tested and held as support, that's when the buyers really gained control of this market over the intermediate term time frame. And we've seen that rising 5-day moving average. And I'd like to point out that you generally, in the intermediate term, want to trade in the direction of that 5-day moving average. Now, we had a little scare on Thursday with that gap lower after it apparently the failed move after the Federal Reserve meeting. We had a reversal of that move and then a reversal of that move. So it kind of caught a lot of people off guard in here. And again, I'll point out that bear markets tend to be more volatile than a bull market. But if you keep your eyes on the trends and keep an eye on those key technical levels, and we were looking at 132 as the key support in here, then it allows you to organize the market with more structure and see some clarity through that chaotic intraday action that we see back and forth, and allows you to pick your points much more clearly. So when we look at the let's take a look at the weekly time frame. I've been saying that perhaps we're going to bounce up towards that 50-day moving average up near 143, 144 if it could make a higher high this week. It has made that higher high. Now we have the potential maybe to get up towards that level. The 137 area was the key level of resistance here over the last week, and the market cleared that level and is now back in control from the buyers. We saw a little bit of volume trailing off on Friday again, and there's still, I look at the individual charts, there's so much damage done to this market that when you look at where the big gainers are coming from, they're in stocks that are basically broken, stocks that really need to heal more through time. Don't lose sight of the fact that the overall primary trend still remains lower, and this area up in here that was so important as support near that 143 area has the potential to offer significant resistance on the way back up. Don't think that everything is okay once again just because we had a 5% rally in the S&P 500. The sharpest rallies often occur in primary downtrends as shorts get squeezed, bargain hunters come in, and those people end up regretting their purchases. Just be disciplined and maintain focus on the overall trend. This trend line still does actually have significance in here. As you can see, a 2-week battle at that area, the market found support. So maybe we're going to come back down and test that. But I still think that right now the buyers have control of the intermediate term time frame, and that has to be respected within the overall downtrend. If you take a look at, for instance, the move from this high right here in 2005. If we take a look at the, where that rally really took hold, and what we're doing is drawing a VWAP line, the volume weighted average price, and you see that level moves. So it gives us the average price up to that period of time. Now if we take a look at it, you can see that from this area where the market kind of broke to a higher high right in here, and then that level acted as support. From this period of time, late 2005, the average price the S&P 500 changed hands at was about 141.5 or so. So we've got the potential for a source of supply to be released, as a lot of people look at this market and say, enough's enough with this market. If I can get back to break even, then I'm out. And that's why support broken often becomes resistance, is because the people who had made significant purchases in these areas look at the chance, the opportunity to get out even, and then they move to the sidelines, and short sellers begin to anticipate that source of supply. So they'll start to sell short up in that area as well. And it just becomes an area where we get more supply, less demand, as people look at this and say, well, I'm not going to buy after this huge rally. So look for this to be a key level in the coming week, maybe about 141.5 up towards about 143. We could also take a look at some Fibonacci levels off the most recent leg lower, which began late in December to the recent lows. And you see here that this level, the 2/3 retracement, comes in at about 141. So I think anywhere from 141 to 143, if you've been participating in the long side of this market, in, again, a primary downtrend, there's a lot of reasons to think that there might be supply in that area. So keep an eye on the trends of the 30-minute time frame. Look for evidence that this 5-day moving average might be beginning to flatten out. If that's the case, tighten your stops and look for, if the market starts making a lower high and then a lower low, then it's time to get back involved in the quid and the SDS, which is the SDS is the inverse S&P 500, which is in a downtrend now because the spiders are in an uptrend. So those are level things just to keep an eye on. But on Friday we saw that the 138.54 level was taken out, and so now the buyers are exerting a little bit of their dominance in here, but it's their game to lose, basically. The sellers are in control of the longer-term trends, and you have to keep an eye on that while you trade these shorter-term trends. So the goal is to trade the shorter-term trends, but to be aware of the overall bigger picture and where the potential key levels of support and resistance are going to come into this market, where there might be a reversal. It doesn't mean there will be resistance at that 50-day moving average or that 141 level, but it's a potential area, and you have to just be extra alert in there, just like we saw in the semiconductors. The semiconductors have been in this horrible downtrend, and I've been saying for the last week and a half that the key level of resistance that the market had the potential to rally past was this 365 level. And what we saw on Friday was that this 365 level was in fact taken out early on, and then the market came down like it often does. We get that rally, that initial rally, then that prior level of resistance is tested, acted as support, and in here was the time to buy. The time to buy the semiconductors for a trade, because the primary trend is still clearly very damaged and lower. But we've been looking for the potential for a short squeeze, and short squeeze rallies are often very quick. And this group was up 7% last week, the semiconductors. So, from these damaged indexes and stocks, we can see some large rallies, but they're destined to fail because the overall primary trend still remains lower. We've got a rapidly declining 10, 20, 30, and 40-week moving average. So the trends are still clearly lower. They're badly damaged in here, and the market made it up to this level of prior important support. So now you got to look at it and say, well, is there going to be enough supply released in here to halt this rally if you're long? Again, when you're trading these counter trend rallies, basically the primary trend being lower, the counter trend movement, you've got to be aware of the potential areas of resistance. You can also look at this as kind of a somewhat of maybe a double-shouldered, two left shoulders, two right shoulders, head and shoulder pattern. The height of this pattern is 335 up to that 365. That would indicate a target up towards 395. So perhaps, even though we see the potential for resistance at 380, a lot of times these markets overshoot those levels and continue higher. We've got the 50-day moving average right at about 393. So maybe the semiconductors can continue this counter trend rally up towards 395, but you can't just buy it and then stick your order in the sell up at 395. Instead, you have to monitor the trends on the shorter term time frames, and as long as it continues to make this pattern of nice higher highs and higher lows, then you want to continue to be trading in the direction of those shorter term trends, but not with large share size, because the odds favor that this rally will fail. That's typically what happens in a primary trend, which is lower like this. The IWM Russell 2000 also had a great week, up 6% last week. making a nice higher low and then higher highs here as it broke past that $70.50 level we'd been watching. So now the market is heading back up towards that key level of prior support at 73. Now we've got that 50-day moving average also declining to meet in that area. A lot of times people make their decisions to buy or sell based on the 50-day moving average. So that's one potential reason to think that supply might be released to the market there. We also have the potential for supply to be released based on the fact that this prior level of support is now being tested. And it has the potential for resistance. So when we have a couple of technical factors coming together in the same area where there might be the potential for participants to take the action of releasing more supply or decreasing the demand for it, it becomes a level where there is often a kind of self-fulfilling prophecy where that support broken becomes resistance, or where that 50-day moving average does act as resistance. We saw the 10 act as resistance, then the 20. Now perhaps we're going to see the 50-day moving average. These are just, it's not a trading system. It's just a way to organize the market to some structure where we can see where the potential for action is. And that 73 level, we had an eye on that 73 level as support for months before it broke down, and the breakdown was a significant event. Now we're testing that level. It pays to be very cautious in this area, in particular when we have the primary trend, again, the 50, the 200-day moving average are telling us that net the sellers are in control of this market. And when we see these rallies up towards that level, we have to pay particular attention to the potential for a reversal in that area. Again, there's no technical evidence that this market is slowing down whatsoever here in the short term. We've got a nice rising 5-day moving average, but we're just coming into an area where the market is getting extended. The rubber band's getting back extended to the upside. If we take a look at Fibonacci, let me just clear all this stuff off and say from these late December highs to the recent lows, the 2/3 retracement also comes in around that 73, 74 area. So another reason to think there might be a source of supply. So we have, so one group of players might be just focusing on selling short at the 61.8% retracement. Another group might be saying, I'm going to sell my longs when it gets to 61.8%. Another group might be coming to that same conclusion near the 50-day moving average or near that 73 level because it was prior support. So there's a lot of reasons technically to look at this 73, 74 level as an important area and to kind of slow down after this market gets extended. So it's going to be a critical week. Once again, another critical week going forward for this market. The NASDAQ continues to be the laggard. This group was up 3.6% last week, just a 1% gain on Friday versus much bigger gains. The S&P was up 1.5%. Semis, obviously, they were up nearly 6% on Friday. But what's amazing is actually that this market was able to be up at all, considering that Google was down 9% with its $45 or so loss. Most people, if you told me that the NASDAQ 100 could be up with Google down 9%, I would be skeptical. But you got to trade what you see and to spend what you believe. So we're still, we still haven't seen the higher high here in the NASDAQ. And that's reason for concern. That's showing us that this market is clearly lagging the other indices. We've still got, and again, we've got something that a lot of larger institutions look at is the 50-day crossing the 200-day moving average. So that's something that occurred a while back already for the S&P 500. Back in here, so we can take a look. The 10-week now, if we look at a weekly, crossed the 40-week moving average somewhere back in December. So now on the NASDAQ, though, we've got that event there, and that gets a lot of institutional investors' attention. So just another reason to continue to be cautious, and a reminder that the primary trend is lower. There's always the opportunity for bounces within the primary trend. But as long as these moving averages are trending lower, guilty till proven innocent is the way you want to look at this market. So that 46 level continues to be the important level of resistance for this market that it'll have to clear to confirm that the intermediate term trend is higher. We do have the 5-day moving average finally rising but it's been slow to move in here. As this market's just kind of been sideways in here. So above 46, maybe we can get a little bit more of a bounce. Maybe we can get it to bounce up to the next potential level of resistance, which is this prior support near about 48 to 40, to 48 to 49, I think. That would be a great rally from here, but the primary trend still remains lower, so you have to be cautious. We are still in the middle of earnings season, and as Google reminded us, and a couple of these other stocks that are really blowing up on earnings, that there are risks. Look at VMware, never recovered from that drop. Digital River on Friday, another tech stock that a lot of people look at, had a terrible day on earnings. And look at the weekly time frame. These things are still a mess. You can still get great rallies like Digital River did, right in here, but look at the direction of the 50-day moving average. When the direction of the 50-day moving average is lower, guilty till proven innocent is the way you want to look at it. You can get trades, but don't be surprised when these stocks gap lower or some bad news comes into the market and there's a negative reaction.